Phil was really excited about the new product line he was bringing out. It was a $1 million a year, highly profitable opportunity. We looked at the size of the market. He was in that market space. He'd been running a company that provided services, administrative services to a particular industry. In the course of providing those services, he had done a ton of automation to make his operations more efficient. As a consequence, he had identified a software, kind of do-it-yourself opportunity that he could sell as software as a service. It was pretty inexpensive, was $99 a month, so not a break-the-bank type of software. He was excited, he was sure he could sell it, and he'd been working on developing it. He'd hired a couple programmers and been developing it for a couple years, invested a lot of money. Probably, he hadn't kept real close track, but probably somewhere between $300,000 and $500,000 in the development of the product. And it looked like it was going to be really good. In the course of meeting with him, I was asking him questions about the sales and marketing as well as the development of the software. He was very confident that he understood the market. Phil had been in this market for a long time, really didn't see any problem selling it. So he really wasn't worried about it and didn't want to spend time on that plan, was so focused on getting the development done. Next time I talked to him, the development's done, and then we talk, and I realize he's using cold calling as his first outreach mechanism. So he's bought a list, he's cold calling, following that with emails, trying to set appointments, then to demos, and it's a B2B sale, so what he found is often it would require more than one decision maker. It wasn't just putting on a credit card. Even though it was $99 a month, it was operational, so involved a number of people, and how do we fit this to into our organization. So the sales process went from just, hey, I'm going to make a phone call and follow up with emails, to we're doing these demos. So he's got the 2 cold callers, and then he's got a more senior salesperson who's supervising them and helping them with doing the demos, and also following up after the demos, trying to close the sales. And the success rate was pretty good in terms of the percentages. He was getting like a 7 to 8% response off of the cold calls and initial email sequence. Pretty good. Eventually, after you get through all the demos and all the process, it looked like he was going to be able to close about 2% of the initial contacts. But what he really hadn't thought through was some of the numbers around how much that was going to cost him. Once you walk through the cost of acquiring the list, maintaining the emailing software, the CRM, paying the cold callers, paying the sales manager, what's the cost of time from that sales manager in the demos, in the follow-up, all of the follow-up afterwards, getting to the close. And what it turned out was it was about $2,000, maybe a hair less, but about $2,000 per closed deal. And since one closed deal only produced $99 a month, he was having to spend $2,000 up front to get a $99 a month agreement. And so it was taking months to pay back just the cost of getting that sale. On top of that, he had overhead for operations of the software. He had servers, he had maintenance programming, he had support costs, and so he had to maintain that overhead as well. And so because of that overhead, he needed to get to over 100 and some users just to break even. So even at the rate they were closing sales, it was clear it was going to take them over 18 months to get to a break-even point with the software. So the problem was, even though the software is very profitable once you get to scale and move forward from there, the investment was going to be at least $150,000, probably closer to $200,000 of sales cost in that 18 months that they needed to get to break even. And there's going to be another $150,000, maybe a little bit more of operational cost in that 18 months to get to break even. So what that means is that Phil, having already spent $300,000, $400,000, $500,000 on the software, is going to have to come up with another $300,000 or $400,000 to get to break even. Now the problem is he didn't have another $300,000 or $400,000. His administrative services business had been somewhat neglected by the fact that he's spending so much time developing the software, now selling the software, and so his profits there had shrunk, and he's not able to fund the cost of getting through that startup period to break even for the software. So he's looking at the challenge of having finished a product. It's fundamentally a profitable product, but not having the cash flow to make it a successful business. Because the market size wasn't huge, 1,000, 1,500 companies were potential buyers of the software, and so that would get him over $1 million of, probably closer to $2 million of revenue, which would be, say, $1 million, $1.2 million of gross margin on the software, and after overhead and admin, probably $750,000, $750,000 of after-tax profit each year. So that's great, but that's probably probably more like 4 or 5 years down the road. And so he would need an investor to come in and bring in at least $250,000, and the investor would then get a share of that $750,000 a year 5 years from now, or at least 3 years from now. So he was never able to convince an investor that that was worth the risk, that investing that much to get that small of a return was worth the effort. And so that was a real fundamental challenge. What do you think Phil did from there? We know that Phil now understands the difference between a profitable product and a cash flow positive product. We do change the names and details on all the stories we tell, but we have a new story at least once a week. Subscribe to the channel, hear more interesting business stories.